of the economy, and who better than Rahul Bajoria, head of Indian and ASEAN Economic Research at Bank of America Global, joining in on the show right now to talk about exactly that. Rahul, great to have you today on ET Now. I want to first talk about, your revised rupee forecast to 94 to the dollar by mid-2026 is what you predict. What would get us to 94, you think? Is it primarily the oil story or the BOP deterioration? And now with sort of Iran and the US trying to at least, reach a resolution. Do you rework that 94 level now?
Lovely to be here. So I would say, the numbers were done before the RBI came out with the measures that they did in the last couple of weeks. But I think, Aisha, the main underlying issue remains with the balance of payments, right? So effectively, if you look at the gap between the current account deficit, which is now widening because of the energy price shock, and then the capital flows backdrop, which remains relatively fragile given, the uncertainty around the economic outlook, but then also, policy measures that have been deployed, would basically mean that we will run with a small BOP deficit, at least in the near term, which can very well take us back towards 94 levels. What we are also, though, saying is that over the next 6 to 12 months, as the uncertainty fades, hopefully energy prices come down, the dollar starts to weaken, you should see the rupee appreciating at the margin by the end of this year. So we should kind of stabilize around 93 levels. But I would flag that there is just significant uncertainty about any spot projections at the moment.
That's going to be the third straight year of negative BOP, right? And $88 billion on the CAD, that's quite a staggering number if you ask me. Can the RBI realistically defend the rupee? And what is it that internally it can do amidst this kind of global situation that we're currently in and the flux that comes with it?
No, absolutely. And I think that is, in a way, the most fundamental challenge of, the way the external balances are set up, is that till, say, the last couple of years, when our current account was manageable, but we were having capital outflows and, there was a dearth of net capital inflows in the system, it was still manageable with the reserve position. But with the widening in the current account deficit, and again, with the caveat that if commodity prices come down, the problem and the gaps are going to look smaller, there is still going to be a challenge as to how do we attract capital, right? And in this situation, measures to increase capital inflows, I think, is what is ultimately needed. And I think that should be the core focus in the next, coming weeks and months, as far as both Delhi and Mumbai is concerned, to stabilize the currency.
And Rahul, how comfortable would the RBI be? At 94, clearly, hi, firstly, this is Harsh joining in. At 94, the RBI has been comfortable around that range. Could it slip further, and would the RBI be comfortable with that? What's your sense?
So I think if we kind of go by the guidance we got from the governor yesterday, RBI is, and I think this is well proven that they don't really track any particular levels. What they are more worried about is the pace and intensity and the disruptive nature of the sell-off. And in that situation, I think, if there is a current account widening, the RBI would let the rupee adjust. Now, whether it is 94, 95, I think there are a bunch of factors which play into this entire situation. I think even in the recent episodes, 94 will not be lifetime highs, right? So from that perspective, they would probably be okay. To me, what they do to attract capital inflows going ahead, whether it is a policy thing or there's a restoration of the growth momentum, which in turn organically brings in money back into the country, I think that is the more important question to ponder over as we sort of look at the end of this crisis management, but then we sort of think about, where do we go from here?
In terms of capital flows, Rahul, we've seen significant outflows on the capital front. Do you believe we're at the fag end? Do you believe that there is still scope for capital outflows? How should one look at that moving piece?
So, I mean, a lot of the capital outflows in the last, say, 6 weeks or so are just a reflection of, funds basically lightening up on the risk they are running. And so it's not just India. We have seen capital outflows across emerging markets and across Asia. So I wouldn't say we are being singled out. Obviously, we have a large exposure to the evolving crisis. And as a result of which, we did get impacted quite a bit. If there is, some pockets of value developing, as I said, we are not particularly negative on the rupee from a medium-term standpoint. And so there will be value generation and, there will be some, value creation, which can bring in money back. So in the second half of the year, we are looking for capital flows to make a return. But I think the real question mark is that going to be enough? And that is a very, very hard thing to ponder about as things stand right now.
Rahul, from where you look at it, I mean, yesterday's RBI commentary and, of course, the move, is it a given that in the due course of this year, we should brace ourselves for rate hikes?
So I won't say it's a given, even though we are forecasting a couple of rate hikes at the end of the current fiscal year. But I think it really depends on whether this manifests itself into a growth shock or an inflation shock, right? So if you look at the current situation, I would say in my conversations with policymakers, there's been a far greater emphasis on availability of supplies of raw materials, of energy, than there is about prices, right? Because if it's a shortage of inputs, it manifests itself into a growth shock. But if it's more about the pricing and the availability is not an issue, then it's an inflation shock. And if we are in an inflation shock and the growth numbers, broadly pan out to where the RBI is putting it at about 6.9%, there is a case that maybe some monetary adjustment would be coming. But if growth slips below 6.5%, if there's a supply problem, I am not entirely sure whether the RBI would be comfortable hiking rates, because it adds to the problems and not really provides any solution in the medium term.
What are you seeing in terms of downside risks to RBI's inflation projection? They've hiked the Q2 numbers. They've not hiked Q1. Any downside risks that you are seeing? And if so, how much?
So I think the downside risk is coming more from what we are seeing in very, very high frequency prices. So vegetable prices, even cereal prices for that matter, because of the ongoing supply glut, has actually been moving lower rather than higher, which is, kind of against the seasonality of some of these prices. But the impending nature of, say, a fuel price hike potentially coming in the month of May, coupled with the fact that we are seeing global El Nino conditions, starting to build up, would make me think that the downside risks are limited, and there is going to be some upside risk coming through. If you see commodity prices, particularly oil and energy prices, slip dramatically if supply normalizes quickly, that could be a potential source of downside. But that is not an India-specific risk. That is a global price risk that we have to kind of contemplate about.
Okay. Rahul, thank you so much for joining us this morning, contextualizing that. Always good to have an eye on the economy and at a time like this when things are so fluid. Thanks for coming in and giving us that perspective. Okay, and what we'll do, viewers, is slip into a very short break, come back, have corporate conversations. Stay with us here on ET Now.
Back with the market right here in ET Now. I just want to check in on the market because look at what's happening to crude, and that's clearly acting as a mirror image on how the markets as well are panning out. We've given up the 24,000 mark. We've given up the 23,900 mark on open. And now we're even sub the 23,800 print when it comes to at least the spot Nifty. The Nifty futures, of course, circling around the 23,894 thereabouts mark, 162 points lower, no less. Eternal, that's your biggest crack. It's at 238 levels. Infosys is down 2.5%. M&M has slid 2.25%. Interglobe Aviation is down 2%. You've got HDFC Bank, which has cracked about 2%. And L&T, ICICI Bank, Maruti, Shriram Finance, that's where you're seeing the deeper cuts. Today, of course, it's really metals which is actually holding out. Hindalco up 4% as we speak right now. Nalco is the other one. Bosch, of course, new specific mover. BHEL is holding out well. And HAL has sprung up about almost 3% as we speak right now. That's Hindustan Aeronautics. But let's figure out what's happening with Swan Defense. And we've got Vivek Merchant, the director at Swan Defense and Heavy Industries, joining in on the show right now. Vivek, great to have you today on ET Now. Thank you so much for your time. I want to first start by talking about, this crucial turnaround journey that you're currently on following almost an insolvency resolution plan. And now you've garnered this very significant order wins as well from various domestic as well as international sources. When is it that you expect to turn EBITDA positive? Throw some light on that.
Right. Good morning. So Swan Defense and Heavy Industries, we've just acquired India's largest shipyard located in Pipavav in Gujarat on the west coast of India. We've taken this yard out of NCLT in 2024, and since then we've renamed it as Swan Defense and Heavy Industries. The facility is a fully integrated facility where we have new shipbuilding, ship repairs, and heavy engineering and fabrication. So it's been about 2 years and a little bit since we've entered into this acquisition, and we do have an order book which is we have an order book across the three verticals, and we expect to reap the benefits of this acquisition as early as this year.
Okay, and Vivek, give us some sense with regard to the current order book size, as well as how execution is likely to play out, at least over the next couple of years, with regard to that order book.
In terms of the order book, I'll go one by one. On the new shipbuilding side, our order book is about $500 million, which has been built within a short period after re-entering the shipbuilding market in 2025, mid of 2025. So the order book really on new building comprises of three separate orders. One is a 6-vessel chemical tanker order, which is a first for India because chemical tankers have never been built in India before. The second is a 4-vessel dual-fuel Kamsarmax order. This is bringing advanced dual-fuel ammonia technology to India for the first time. And the third is a defense export order to the Royal Navy of Oman. So these contracts are complex, relatively high-value contracts, and they provide us with a strong revenue visibility over the next 3 to 5 years. This is on the shipbuilding side. On the ship repair side, the projects are typically 30 to 45 days in terms of a cycle. And as we speak, we have 4 ships and a rig at our shipyard docked for repairs. This is a continuous business that goes on throughout the year with visibility of about 3 to 6 months in terms of a pipeline. And the third vertical, of course, the fabrication vertical, we do have our first order in place here as well, which is to manufacture barge unloaders, which are used at ports across the country. This is for an Indian customer, and this project will be completed within 6 to 7 months.
So I missed that, Vivek. Where exactly is your total order book as of date? What does it stand at?
On the shipbuilding side, we are about $500 million.
Okay.
And then we have the ship repairs and the fabrication orders, which are slightly smaller in value, but also quicker in turnaround.
So I want to specifically talk about NEO because, that has a capital investment program of about $2 billion. Tell me, what kind of additional order inflows are you anticipating from them in the future?
Right. NEO is a fund that has positioned themselves in the direction of green shipping. We have currently an order of 4 vessels for the dual-fuel ammonia Kamsarmaxes. And we have the option to add 2 more vessels to this existing order. So that's where we are at currently. After that, we see where it goes from there.
And Vivek, just give me a bit of a breakup with regard to that top line. The repetitive business, which is the ship repair business, typically what's the kind of size of ship repairs that you do annually, or you're targeting annually, maybe not right off the bat, but maybe a year from now, because that business will likely stabilize and those revenues will start to get stable, right? I'm trying to get a sense as to how much can one pencil in from that.
Right. So ship repairs, as I mentioned, has a 30 to 45 day cycle. So we can expect about 10 to 12 cycles a year. And in terms of internal targets, we have anywhere between 175 to 200 crores in terms of a target for ship repairs this year. And we intend to scale that up as we go forward. The entire scaling up will depend on the overall business across the three verticals. We will then optimize and see how to increase the efficiency of the output from this very capable asset that we've acquired.
And with regard to the contracts that you won, how does revenue recognition happen? Does it happen in a phased manner? Does it happen on delivery? Give us a sense of how the accounting works and how those numbers will start showing up on your P&L and how to read that.
So if I look at the shipbuilding side, in terms of our existing order book, we expect to deliver our defense export ship as early as next year. For the commercial vessels, like the tankers and the bulkers, deliveries will begin in just under 3 years and continue through 2030 and 31, which are pretty standard timelines when it comes to such specialized vessels. So when it comes to revenue recognition, the orders placed are usually on payment structures of 20% into 5 and any such variation. So across the 3 to 5 years, we expect these payments to come in as we hit each stage.
So what percentage of the revenue is split between shipbuilding versus ship repair?
Currently shipbuilding, and I think for the foreseeable future, shipbuilding will be the largest basket for us. I think the new shipbuilding revenue is maybe about 80% of our revenues today. And the remaining is split with ship repairs and fabrication.
I'm still curious to know, when is it that you turn EBITDA positive?
We expect to turn EBITDA positive this year itself. We've been doing our homework and groundwork for the last 2 years, and we see our efforts bearing fruit as early as this year.
And Vivek, just to kind of break this down, I know that it's very difficult to arrive at an EBITDA, a steady state EBITDA number right off the bat. But what would that number be? Because some of the peers in the shipbuilding industry, would you match that? Would you exceed that? Give us some color on it, because you've already started winning contracts, and therefore there'll be some amount of financial the kind of modeling that you would have done to kind of arrive at what's the kind of margin that you'll make.
Right. We can expect comparable margins from SDHI. If I had to just split up the demand drivers in India today, we have our commercial shipbuilding side, where our inquiry pipeline is about 2 to 3 times our current order book. In addition to this, there are 2 strong demand drivers in India today. The first is the government-backed procurement through Shipping Corporation of India. The Ministry of Port Shipping Waterways has aggregated demand to about 400 ships to be built in India for India, of which about 60 ships are expected to be placed on order within this year. The second demand driver is, of course, the traditional defense shipbuilding programs that have been executed through the Ministry of Defense in India. So both these sit over and above the commercial pipeline that we already have. And so today we are seeing strong visibility, not just in current orders, but also in future opportunities. And in terms of P&L and balance sheet, we expect to be able to bring ourselves not matching, but somewhat in a similar position as the other shipyards in the next year or 2.
Okay.
Vivek, just very quickly, I'm trying to understand how capacity utilization evolves for you. So you're obviously, it's like a reboot of the whole company, right? I'm trying to understand whether all of the orders you've taken on board maxes out your capacity. Are you able to take more orders which get executed right off the bat, or maybe after a couple of years? How does it play out? Give us a sense of that.
Right. In terms of execution, so one important thing to note is everything we are doing at Pipavav today has been done before successfully. We're not reinventing the wheel. We are only restoring and restarting this facility that we have. In terms of the last 2 years, what we've done is we've rebuilt the team from about 300 to 1,200 people on ground today, and this will continue to scale as projects ramp up. Today, we have all key licenses and certifications in place. We also have our partnerships in place across design houses, technology providers, and global shipbuilders. So our approach has been, of course, to first sweat the existing assets and then expand in a calibrated way. At Pipavav, we have about 600 acres of land, of which only around half has been currently developed. So this gives us significant headroom, not just to upgrade technology and equipment, but also to scale capacity meaningfully. And the broader vision at Pipavav is to develop into a maritime cluster or hub, and we're currently firming up our plans in that direction. So if I had to say, today our capacity in terms of steel throughput is 164,000 metric tons per annum. And our current order book represents about 50% of that fabrication capacity.
Okay, thank you so much, Vivek, for coming in and speaking with us. This gives us great perspective. So you're at $500 million. Very likely you can go up to $1 billion in terms of order book size. That's really my reading. And of course, you can go beyond that, but you'll have to stretch timelines and increase capacity both. Understood. Thank you so much for coming in and speaking with us.
Thank you.
All right, viewers, in fact, I'm going to take a step back, quickly look at markets. We're down around 0.5% thereabouts on the Nifty 50 index. To try and understand levels better, we have Sajid standing by with the FNO snapshot. Sajid, what's the FNO cues adding up to? What are the levels that you're looking at in terms of the Nifty?
Thanks, Harsh. It's a correction morning, which we are seeing with our call writers being very active and across the strike prices there. The Nifty down nearly 0.6%, so it's fallen off in the last half an hour further, with the open interest up marginally. So there is a long unwinding which is also happening, because we have, for the last 2 trading sessions, we have seen some of the short covering happening, and that led to the Nifty going close to 24,000. So if you look at Nifty Bank, the Nifty Bank is also seeing nearly 0.5% cut with open interest down. So some of the long positions which were there in Nifty Bank are getting cut as we speak. And if you take the snapshot of what's happening within the banking Nifty Bank, you have ICICI Bank, where we are seeing some shorts getting built, ICICI Bank which is seeing some shorts building, and SBI. There's a long unwind which is happening in Axis Bank, but some long buying seeing in BOB, Bank of India, and Bandhan Bank, where we have seen some long buying there. Otherwise, it's basically unwind of some of the long positions or short positions getting built there. Look at the Nifty options snapshot, and it will give you a sense of how the call writers are active in the morning. You have, we started the day around 24,000. We've seen a good activity happening by call writers on 24,000, and then they're pushing the index lower to 23,900, and now there's some activity happening in 23,800. And if you look at the distribution chart, it will give you a sense where it is. We are around 23,800. Again, we are seeing call writers being more than the put writers there, and there's a good resistance coming in for the market at that level there. Futures gainers, include interesting stocks today. HAL, long buying, seeing 4.5% up. Cochin Shipyard, BHEL. So defense is active and in the futures market today. You have Hindalco and metal stocks also, showing up nearly 3% gain in today's trade. But in the losers, you have stocks like PG Electro, where there's a short build-up which is happening. Info Edge numbers came out, decent numbers which is there, but still some short build-up happening. And Ambuja Cement and Keynes are the other stocks where we have seen some shorts getting built up as we speak. Open interest gainers include stocks like Godfrey Phillips, Cochin Shipyard, and Nippon. Godfrey and Cochin are seeing some long build-up happening. Nippon is seeing some short build-up there, and so open interests are up for all of them from between 6 and 19% respectively. among the losers, you have, Adani Power, where there's a long unwind which is happening. Adani Enterprise is also seeing some long unwind. Sale is seeing some short covering, and the stock is up. But since the opening is down nearly 1% in today's trade, look at the most active stock options. HEL 4000 April call. We mentioned about the fact that how HEL was active in the futures market. The premium up nearly 116 rupees to 189. There is 9.45 thousand, means 94,000 contracts which have got added in HEL at 4,000 April call there. The other call option which is active today is TCS 2600 April call, where the premium has fallen by 0.6 or 60 paisa to 6140. 1.53 lakh contracts getting added, and the stock hovering about the 2550 mark as we speak. In the put, we are seeing HDFC 800 April put. That's one strike which has been active for last couple of days. Premium up nearly 5.6 to nearly 19 rupees, and there's an unwind of positions that's happening with 1.57 lakh contracts falling off. So market is giving up some of the gains that it has seen over the last 2 days, and it's a call writer's morning as we speak.
Interesting. Okay, on that note, let's wind it up right here in this edition of The Market, and it's a good five from Harshan.
End of the market, talk to some of the managements from the mid-cap and small-cap space, and also give you a lowdown of everything that's happening. Now, while the overall market, the Nifty is under pressure by about more than 0.5%, the broad end of the market has managed to hold on to nominal gains. Before we tell you about everything that's happening, here are some of the stock-specific headlines and the top headlines that we've been tracking at this hour. So let's start by talking about the fertilizer space. Fertilizer stocks like FACT, National Fertilizer, RCF, all of them are in focus and are doing well. They're gaining after the centre approved major subsidy for the Kharif 2026 season. The increase in subsidy outlay reflects the government's effort to offset rising global input costs, particularly for key raw materials like phosphate and potash, aiding margins and pricing of fertilizer companies.
The stock of JTL Industries has seen a sharp spike today on the back of block deals carried out yesterday. Bacchus Asset Managers bought 97 lakh shares, or a 2.5% stake, at 54.5 rupees. While Thakkar Nilesh Kumar Farshun HUF has actually sold 1% stake at 53 rupees apiece.
Honasa Consumer is soaring after the company reported a strong business update for Q4. The overall business is expected to grow in late 20s, driven by strong growth across focus categories, with Mama Earth growing in teens. Younger brands are also expected to grow in mid-20s, and the company says the overall operating profit margin profile is likely to be sustained.
And KC International has secured new orders worth 2,518 crores across its civil transportation, transmission and distribution (T&D) and cables and conductors division.
And RITES has received a contract amendment from Hindalco for a railway siding project at Sankarjung. The order value has now increased from 79.7 crore rupees earlier to 118.9 crores.
Now onto the Midcap Masala show. It's time to connect with our first management onto the show, and today we're going to be speaking with the management of Royal Orchid. And let me welcome Mr. Keshav Balji, who's the Executive Director of Royal Orchid Group, joining us on the show. Hi, very good morning. And firstly, let's start by talking about your deal with Hilton. This deal targets to open 125 Hampton by Hilton hotels. What is the expected timeline for the rollout, and how will these signings and openings will be paced over the next few financial years? Give us some sense.
Yeah, thank you for having me. We are excited to announce that we will be opening 125 Hampton by Hilton hotels. As you know, Hampton by Hilton is the leading mid-scale, hotel brand, ranked #1 by Entrepreneur Magazine for over 17 years, and is the largest brand in the Hilton portfolio in terms of number of hotels. We will be rolling this out across six states in India over the next 10 years. So this is the long-term strategic tie-up. We will be the master franchisees. That is the subsidiary of Royal Orchid Hotels Limited. Regenta Hotels Private Limited will be the subsidiary, the master franchisee. And we will be rolling out these hotels in management contracts with hotel partners and hotel owners across 6 states in India.
Balji, that sounds good. I'm just trying to understand a little bit more. Will the business model for these hotels be franchise? Will it be management contracts? Is it going to be a mix of both? And what kind of fee income or margins can Royal Orchid expect over the course of the next 10 years?
So our subsidiary, Regenta Hotels Private Limited, basically is a management company, and we basically are an asset-light business. We manage hotels which are built by third parties. So we have a real estate developer who builds a hotel, and our company then manages it. So we get a fee income, and our EBITDA margins are close to 50% in this business. Currently, our fee income is on an approximate run rate around 45 to 50 crores per annum. We expect this to accelerate quite well due to this particular deal, as well as the growth in our Regenta brands as well. So if there's anything I could clarify in terms of the management contract business, very quickly, basically these are long-term tie-ups. We do not invest in the hotel. The hotel typically costs around 50 to 60 crores to build. That is put up by the landowner or the real estate developer that we tie up with. We take these hotels on long-term contracts. We manage the sales, marketing, talent management, regional sales offices, revenue management, and things like that. And so essentially we manage the hotel on an end-to-end basis, deliver value and growth in terms of both yield on an annual basis to the real estate developer, as well as growth in the asset value over time. So this is a very good model for folks who are diversifying their family offices or their real estate holdings. You get professional management, you get a global brand, and you're able to earn a good return on income as well.
Understood. So that gives us a lot of sense on the operating model. So just the key takeaway from what you've just said is that this is not going to impact your capex requirements, this 125 hotels. No impact on capex, and via this you will still continue to remain with your asset-light strategy, right?
That's correct. That's correct. We basically will be looking at an asset-light growth henceforth. We are opportunistic. We do have a reasonable amount of cash on our books. So we are opportunistic. If there are some assets that come up for sale or on a lease or revenue share model, we will consider that as well. We have been doing some revenue sharing deals as well, which is slightly more capex heavy than the management contract model as well. And you will see that in our top line growth as well for the Royal Orchid Hotels Group, which is likely to accelerate.
All right, point taken. But along with that, Hampton is positioned in the upper middle scale segment. How does this complement or complete with your existing Regenta portfolio?
So Regenta is a full service mid-scale brand which has banqueting, events, multiple F&B outlets, things like that. So it is what is called a full service hotel. Hampton is basically a focused service hotel, which means it primarily focuses on the rooms, and it has limited food and beverage outlets. We are finding that a lot of real estate developers, especially in mixed-use developments, have a lot of restaurants already in the space, and so there is a demand for a room-centric hotel product. And I think this is something that is going to grow quite aggressively going forward. And of course, I think it also works out very well for the developer because you're not building all these extra ancillary services, which typically don't yield as much on a per square foot basis. So we find it's very complementary to our existing portfolio. It allows us to sweat our existing assets a lot more because we've already built out regional management teams, regional sales offices, centralized revenue management teams, centralized HR accounts, all of that stuff. So that stuff gets sweated over a lot more hotels as well, because we now have one more brand to offer to our real estate developer partners. And of course, I think we're also very excited that this is, the biggest brand in the mid-scale space globally. So it is really, for us, a gold standard brand. We're very happy to be associated with Hilton for this.
Really good. Mr. Baldry also talked to us about the trends that you're seeing on the demand and supply front. Now, given your current occupancy and rising ARR, both of them have been rising consistently. Do you see demand strong enough to absorb such an aggressive supply addition? I understand it's over the course of 10 years, but still, if you could give us a sense of this demand and supply situation.
Yeah. So look, since the pandemic, obviously the market has been on an upswing. We actually have been quite aggressive ourselves. We have almost, because we are currently at 125 operating hotels, we have over 50 projects which are coming up now, which means these are signed hotels and they're under construction or being converted as we speak. We have a very aggressive target of 345 plus hotels in our Vision 2030 plan. So we believe that, look, India is definitely under-penetrated with hotels. We believe that in the next 5 to 10 years, there is going to be aggressive amount of hotels being built by real estate developers across the country. These developers need professional management. Today, it's very difficult to attract, train, and groom and promote staff if you don't have a large chain in which you can, provide the career path to employees. And I think that's one of the critical aspects that people are overlooking. And only good talent would like to join, large platforms such as ours. And so we feel we have a unique advantage. And as these hotels get built out, they would require professional management. And therefore, we are positioning ourselves very well for this upswing that's about to come up. But I think that you're right that, look, the hotel business is something that tends to be over the long term cyclical. In the short term, I mean cyclical. But in the long term, there's a huge structural change in the Indian market. As our per capita income will double over the next 10 years, you will find that a lot more discretionary travel will happen. And more importantly, there will be a lot more travel as India builds itself. So every time you hear an announcement of a new cement plant being constructed, a new road being constructed, you know that there is some travel that is required for that to happen. So as India builds itself, hopefully the travelers and the builders of India will stay in a Regenta hotel or a Hampton by Hilton hotel, which is run by us.
All right, good to know about it. But along with that, help us understand a bit more on the financials and numbers. And what kind of ROAS or payback period do you expect from these hotels, especially in the key markets like Goa and Maharashtra?
Yeah, so, basically for us, obviously, we only provide a very, very limited working capital capex for these hotels. So we typically earn a fee income for helping these hotels be set up, signed, and then, of course, earn a monthly fee once the hotel is operational. So we are typically cash positive on these properties immediately. So it's a very high ROCE business for us. But for the hotel owners, because the Hampton product is focused service, so it is very, very high ROCE because what's happening is you are actually a very large percentage of the hotel is revenue earning. You don't have too many ancillary facilities which are not revenue earning. So we expect that the payback period for owners to be a lot quicker, almost 30 to 40% faster than a full service hotel. So payback periods for owners can range from 4 to 5 years to 6 to 7 years, depending on the market, and of course depending on the land cost. Look, Goa, Maharashtra are some of the key markets in the country, including, of course, Karnataka, Tamil Nadu, Andhra Pradesh, and Telangana. All of these markets we have selected, handpicked, because we believe these are some of the most, positive and high-yielding markets in the country. And also, we believe that these are markets that are where a lot of the growth and development are happening in terms of projects, in terms of leisure facilities. So we believe that we can really penetrate these markets with the Hampton brand as quickly as possible.
And Mr. Baldry also talked to us about everything that we're seeing geopolitically, given the ongoing West Asia conflict. And, we've heard the ceasefire to be at play to some extent. Now we're hearing the opposite. Are you seeing any changes in travel patterns domestically? Do you think the sentiment has been marred because of higher, let's say, airfares or travel costs? Do you think this has impacted the demand for travel and tourism, at least temporarily?
Look, of course, there's always going to be some dislocation, especially in the luxury space, when you have this kind of disruption in terms of flight paths, right? A lot of the airlines are having to take different flight paths, and therefore some are cancelled. So therefore, the airfares have soared. And at the same time, there is a bit of uncertainty as well in terms of the market, and of course, you see it in the stock prices every day, which are quite volatile. That being said, the reality on the ground is that we are very much a domestic consumption story. And we believe, and we are basically a trade on India premiumizing in the next 10 years, as we grow our, per capita income. So while there are some small disruptions in very, very minor markets, keep in mind that we run over 125 hotels in 80 plus cities. We aren't seeing cancellations in more than 3 to 4 of our cities. And most folks, for them, domestic travel is on. Business is as usual. That being said, if we have some calamities in terms of large scale LPG or oil. Or even international travel disruption for a very long period of time, then we, along with the rest of the economy, will definitely suffer. But at this point, we don't see that playing out on the ground. So that's very positive for us.
Okay, so that's actually working in your favor. It's not marred any of the demand or the occupancy. So that's good to know. Mr. Balji, lastly, before we let you go, just wanted to get a better sense on your Vision 2030. You're targeting 2x growth. You've already, if I'm not wrong, you already have the target is 345 hotels, like you just told us, from the current 168, 170 number that you have right now. So you're looking to double that. Just want to understand if these 125 hotels are going to get added to this count, and does that accelerate your 2030 plan much before the timeline?
No, at this point, we would be relooking at the 2030 plan. We would like to continue with this current plan of doubling our growth. But we will not, increase our Vision 2030 targets right now. We would like to quickly ramp up. So the Hampton part would be definitely part of our Vision 2030. But we will come back to the market as and when we believe that we can do something a bit more aggressive. We are always looking at that. Of course, internal targets are always higher than what we speak about. We would love to see how this works out over the next 6 to 12 months. But we believe that achieving this Vision 2030 target now looks a lot more achievable with this tie-up, looks a lot more realistic. And I think we can probably beat it as well. So we will, over the next 1 or 2 years, come to the market with what we'd like to do. And of course, there are going to be other announcements as well going forward in terms of new signing, new hotels. And we look forward to sharing that with the public as and when those things are known.
Point taken. But with this, Mr. Balji, we let you go. So good having you on the channel today. Thank you so much for taking the time out and helping us with your outlook and views.
Thank you so much for having me.
All right, so that was the management of Royal Orchid talking to us about their latest deal with Hilton, and along with that, what's the outlook going ahead. We discussed all of that, but with this time now to slip into a very short break.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
has inked a deal with a Japanese firm, JFE Engineering Corporation, and this is worth 750 million yen. So it's a big one coming in for Antony Waste. So let's interact with the management. Mr. Jose Jacob Karakal, the chairman and MD of Antony Waste Handling Cell, and Akira Usui, director of Japanese firm JFE Engineering, are joining us on the show. Mr. Akira, thanks so much for your time. Let's start by talking to you. You are investing 750 million yen in Antony Waste for their Andhra Pradesh waste to energy project. So this is happening via 2 SPVs. Can you tell us what the rationale behind this investment is, and what are the opportunities that you're seeing in the market like India, especially when it comes to waste management?
Just started the waste to energy project here in India. We understood the potential huge market opportunity here. And now the government tried to set some regulation utilizing the waste to energy here in India. And also, our partner, Antony, is the long relationship with the municipalities. So that is why we are here today to sign the project.
All right, good to know about it. But Jose, this is the first strategic partnership with a global player like JFE Engineering Corporation. How does this change your long-term positioning in the waste to energy segment, and what's the revenue that you are expecting from this deal?
Waste to energy is going to be the future in our nation, and there are many cities which is having population of more than 10 million, and all the cities require highly technical waste processing facility, and waste to energy has been implemented pan-India in a few places, and worldwide it is running very successfully. And JFE, the partner, has set up around 250 plants worldwide, and they have 60 years of experience. So it's very important to have a good technically advanced company who has successfully executed such projects. And we look forward to set up these two state-of-the-art technology plant in Andhra Pradesh, which is in Kurnool and Kadapa.
So on that note, Mr. Kalarakal, what is the upcoming major capex plans that you have lined up for FY27?
So this both the plants will the total capex will range in around 650 crores, and that's it. And we will be completing the plan in around 22 to 24 months, and that's our plan is.
But Akira, just wanted to understand that currently you are acquiring 25% stake in these SPVs, but going forward, any plan to do additional investment?
Yes. This time, JFE has the two sides of the aspect, technology leader and a strategic investor. We have a JFE. So this is the first step, and this is the stepping project for us. So as I said, we have a potential market here in India. So gradually, we try to find out and invest. And of course, we do the EPC as well.
Okay, and Mr. Kalarikal, currently 61% of your revenue comes from MSW collection and transportation going forward. If you could help us, what is the revenue mix that you're expecting?
So we will definitely go more than 50% in coming years. Because waste processing has become very important part in pan-India. As you are aware, that many cities have not yet gone into a scientific processing, and they are in the process to do scientific processing of waste by disposing it scientifically and to reduce the environment impact in their cities. And one of the technology which many of the cities will adopt is waste to energy. And since it is proven worldwide, and we believe that this sector will grow and definitely outshare in this sector, in this waste processing part will definitely grow big.
All right, but along with that, because the West Asia conflict, many sectors have seen an impact of this crisis and we are definitely seeing what's happening with the raw material prices. But for a sector like you, can you tell us that any impact that it has done to your sector for now?
Since our sector is an essential service sector, which is very important for every city, waste has to be collected, waste has to be processed. So international impact or more and all will not be much on our sector because it's an environmental impact for the citizens living around, and city has to be kept clean.
Okay, and if you could also tell us what will be your top line projection for FY27 and let's say for the next 2 to 3 years as well?
As far as growth is concerned, we are having a steady growth if you see in the last 5 years, and we believe we'll maintain that growth in coming years.
All right, and lastly, Akira, any more investments in India going forward in the waste management sector? What do you think about this?
Yes, we are now thinking. Yes, I cannot explain the detail. However, we will find a good opportunity. We will do.
It's not ruling out any further investment in India. At least that sounds good. Thank you so much, gentlemen, for your time today. So, viewers, that was the management of Antony Waste on this 750 million yen deal that they have secured from the Japanese company JFE Engineering. But on that note, viewers, we're completely timed out on this edition of Midcap Masala. Thanks so much for tuning in. But stay on to ET Now. Buy Now Sell Now is up next.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी